Every single number on our scorecard this week is red, and oil is up more than 6%. That's not a coincidence. It's rare to see the US, India, and oil all move the wrong way for you in the same week, but that's exactly what happened. Tuesday night, missiles landed in the Gulf, not somewhere far away, but a few hundred kilometers from where a lot of us are sitting right now. We need to talk about what actually happened calmly and what it means for your money, not just your nerves. 30-year US bonds are now paying over 5%, and that's quietly doing more damage to your tech stocks than any headline this week. Yes, boring old bonds. We'll get into why that's the real story behind Wall Street's bad week. Lot to get through, so let's start with the scorecard. Let's start with the US, and it isn't pretty. S&P 500 down close to 1.5%, Nasdaq 100 down even more, off nearly 2.5%. Tech took the bigger hit, and we'll get into exactly why in a bit. India actually held up better this time. Nifty 50 down under 0.5%, Sensex down about 0.6%. Still a red week, but nowhere near as bad as the US had it. The rupee slipped a touch too, up about a 0.25% on USD INR, small silver lining if you are remitting home this month. And then there's oil. Brent crude up close to 6.5% this week, its second straight week gain. That's where our geopolitical corner starts. Here's the big one, and this time it hit close to home. Tuesday night, the UAE picked up missile fire heading towards it. Two ballistic missiles that ended up splashing through harmlessly in Gulf waters. No casualties, though it was enough to trigger shelter in place alert across the country for a while. Iran denies firing them. The UAE's own assessment is that they were aimed at shipping traffic in the Gulf, not the country directly. This sits inside the wider US Israel Iran conflict that's been running since the end of February, largely fought over who controls the Strait of Hormuz, one of the most important oil choke points on the planet. In response to Tuesday's missile fire, the UAE suspended all trade and financial transactions with Iran indefinitely. That's not a symbolic gesture. The UAE was one of Iran's biggest trading partners, supplying close to a third of everything Iran imports every year. And Hormuz shipping has basically collapsed. We are talking roughly a tenth of normal ship traffic passing through the strait right now. Put that together with Washington saying it wants to squeeze Iran's economy even harder, and you have got your answer for why oil just had its best 2 week run in a while. Now, before anyone lets that missile headline spiral, let's rewind to January 2020. Iran fired a wave of ballistic missile directly at a US base in Iraq and Al Assad in retaliation for the Soleimani killing. Overnight, oil spiked, US futures tanked, and every news channel was bracing for something much bigger. Within 24 hours, once it was clear no American lives were lost and Iran signaled it didn't want this to escalate further, the Dow, S&P and Nasdaq all closed the very next session higher than before the missiles had even landed. I'm not saying every geopolitical scare resolved that fast. This particular conflict has already run 6 months and counting, but markets have a genuine track record of digesting these shocks a lot quicker than our group chats do. The missiles landed in the water. Don't let the panic land in your portfolio. Here's the twist. The story that actually did most damage to your portfolio this week probably wasn't the Middle East at all. It was bonds, boring, unglamorous government bonds. Yields spiked to multi decade highs almost everywhere at once. The US 30-year crossed 5.3%, its highest since 2007. Japan, the UK, Germany, all sitting at levels not in seen years, sometimes decades. Four things are colliding here: oil driven nervousness, the US government's own enormous borrowing needs, Japan's inflation pushing its central bank towards rate hike, and this one actually surprised me: AI companies issuing something like $1.5 trillion in corporate bonds this year alone, soaking up money that used to flow into government debt. Here's why that matters for your stocks. A 30-year US Treasury paying over 5% guaranteed suddenly looks a lot more attractive next to a stock market offering roughly the same in earnings with all the risk still attached. That hits growth and tech stock hardest because their value leans on profits way out in the future, and those future profits are worth less today when yields are this high. That's exactly why chip stocks got hammered and the Nasdaq fell harder than the S&P this week. The US Treasury actually tried to calm things down midweek with a bond buyback plan. It worked for about a day. Then yields snapped right back. Markets clawed back a little ground on Friday, but not enough to turn the week green. Next test, the Fed's Jackson Hole Symposium coming up next week. That's usually when the Fed chair says something that moves this exact conversation. Iran didn't sick Wall Street this week. A bond market having a midlife crisis did. That's the wrap for this week. Missiles in the Gulf that thankfully hurt nobody. Oil on its best run in weeks, and a bond market quietly rewriting the rules for tech stocks everywhere. Stay diversified, stay calm, and keep that ship running regardless of what the headlines are doing. If this was useful, hit subscribe. It genuinely helps a small channel like this one. See you in the next one.